We were like the Uber for real estate. There are so many people I meet who own real estate and they think they're profitable, but when they factor in rule number one, don't. The simplest way to think about it is
Welcome back, investor. We got Pascal Wagner in the house today. Hello, Pascal.
what's up, Emma? Thank you for having me.
Yeah, if this is your first time listening to the show, it's a podcast where we talk about how to have more adventures and how you're going to pay for it. Passive is how you're going to get the time to pay for it, and the income is how you're going to find the money to pay for it. So, Pascal is the host of the best ever passive podcast that talks to people about how to get passive income, looking at real world solutions for people who either don't want to work anymore or people who want to spend time working on things that are more their choice and less having to work for money and instead maybe choosing to volunteer, choosing to work for money, run a business, those kinds of things. It's Pascal. What can you tell our guest about your background and what kind of puts you in the position to be able to speak with some authority on this topic?
Cool. Thank you for having me on the show, Emma. So I think to dive right in, my story kind of started when I was working at a venture capital firm called Techstars in 2019 through 2021. I had been through my job at this venture capital firm was I specifically looked at all the companies within the 2,500 company portfolio. And my role was to figure out which companies we were going to continue investing into and write a
Okay.
second follow on check. So 150,000 or $300,000 check and end up making over 300 of those investments at my tenure at Techstars. Got exposure to a lot of deal flow and make a lot of cool decisions. But what then happened to me is in 2021, my dad passed away unexpectedly from old age. And at that time, he had left my mom a large inheritance, a couple $1,000,000. But my mom is in no way financially savvy. My dad took care of all of the finances in our family. And so it really was for me to step into that role and figure out, okay, how do we turn the money that she still has and figure out how to help her retire off of it.
Okay.
And I basically took everything that I knew about institutional investing at Techstars, like creating an investment thesis, figuring out, okay, what's the roadmap? What's the end goal that we're trying to get to? And for us, we say it's like, how do we create her a six figures in passive income and then work backwards from that? And that was really how my passive income journey started. When you first get into this space of being an LP, there's really no other vehicle that I know of that provides you passive income other than these private investments.
Mm,
And it's really an entirely new world with its own terms and its own risks that I needed to learn and figure out.
yeah. You mentioned when we were talking before, because I was on your podcast a couple weeks ago. I did not get a chance to talk to you at the Best Ever conference. I saw you kind of wandering yonder. We didn't get a chance to connect in person. But from the conversations that we've had, you mentioned that you had a startup that you exited. Was that before or after this basically becoming your mom's portfolio manager or
It
before
was
Techstars?
before.
You
Um,
had your own company, then you were working for Techstars after your exit and then with your mom's portfolio. Were you still working for Techstars at that?
yeah. Basically, build a company, got it to a million annual revenue. We had 50 plus employees. We launched in a bunch of different states. We were like the Uber for real estate photography.
Okay.
And yeah, eventually sold that to a national photography firm.
Mhm.
And the next thing I wanted to do was figure out, okay, how do I become a better investor?
Okay.
And working with founders and big ideas at a big venture capital firm felt like a cool place to
Okay.
do that.
Interesting. Okay. I don't know if this came up before. I was a real estate photographer for 8 years. I was a 1099 contractor for a large company out of Austin that contracted with Tour Factory, and they kept me pretty busy, and then I did some freelance stuff on the side for, like, higher end properties, and that experience, it taught me, 1, I never want to be a realtor. That's why I've never gone down that path, but it was one of the things that kind of formed my love of just real estate in general, like falling in love with buildings and falling in love with the people who live there and work there, whether I was doing a commercial building or a residential home, and really set me down kind of a path. So that's funny that you were in that space as well. I don't meet very many other people in real estate who have been on the marketing or photography side of things.
Yeah, I'm wondering if you came across us. The company was called Walkthrough, and we had, I mean, our competitors were like Virtuance and Planomatic, but yeah, either way, cool connection.
I know, yeah. gives me an appreciation for, like, pitch decks, for when I'm trying to buy something or when I wanna sell something, or even when we're trying to rent an apartment. There are just certain things that before you get into real estate, people think they have to be an active investor, and the whole point of this show and the whole point of your show is you don't need to know what good real estate photos look like. You don't need to know how to write copy to entice tenants to your property. You don't need to learn how to manage a property manager. You don't need to learn construction and flips because we've done all that, and I'm really grateful for those skills. I really do like real estate as a business, but there are a lot of people out there who just get into real estate because they think it's gonna be good money, but they don't like buildings and they don't really like the people who live and work in them. And if you don't like those things, then you're not going to be successful. If you want to scale in real estate, then you have to go on top of that to becoming a capital raiser, which is like what you and I do, which is, let's just call it, it's a sales job. I hate to call it a sales job because we're not really selling anything. We're paying people to use their money to go run a business. But at the same time, like the skills and the activities are very similar. And if people don't like sales and raising capital, they don't like buildings and people, like, don't do real estate actively. And here are some options if it's not a good fit for you. It was a good fit for me, and that's why I do it. But my message is out there to people. It's like there are other ways to invest in real estate than owning buildings or managing properties.
I think if I just reflect on my journey, it's been more that real estate was the thing that everyone pushed you to do.
Mm,
There's a whole industry like lenders, real estate agents. Everyone wants you to buy a home because that means the industry is going up. And I think it's confused that people owning and managing real estate is its own form of a business, and it requires, just like any business, that you pay attention. What I think is really fascinating is there are so many people I meet who own real estate and they think they're profitable, but when they factor in bookkeeping and taxes and everything else and maintenance expenses, it's really not, or it's barely breaking even.
yep.
And I think if I reflect on my journey, I didn't even know that these types of opportunities were available to invest with other people and be completely passive.
Yes.
So I think those are some major contributing factors.
So why is it in the real estate world, though? You bring up a good point. I say you have to love buildings, you have to love people, you have to love raising capital. But one thing I didn't mention that you also need to love is running numbers. Like in real estate, people think they have to own their own real estate. They don't recognize that it's a business and they don't know how to run numbers. If something is a good deal, if something's going to cash flow, what the repairs and maintenance costs should be expected. This is something that I think gets away from a lot of rental house owners. I think everybody, most wealthy people should own a couple rental houses, but to pick good ones and run your numbers. If you don't like financial analysis or taking care of, like when we had our largest rental portfolio, it seemed like every other day the mortgage servicer had some problem. Oh, you don't have insurance. We're going to put hazard insurance on. One of them tried to tell us that we were in a flood zone. I'm like, you guys have had the mortgage on this for 5 years and suddenly we're in a flood zone. They made us buy flood insurance. I had to go and prove that we weren't in a flood zone. Then it'll be something like they'll change servicers and the automatic payment is not working and you didn't know because everything's automated. And so it's, why is our mortgage late this month? And you get a call. Like it's constant, constant, just with the mortgage servicers is annoying. And so people just don't understand like the numbers, the business, all of this. So why is it that people know in tech startups that you can go buy into a private company? Like, oh, my friend's got a startup we invested in. Why don't people know that you can do the same thing in real estate?
I think, yeah, many contributing factors. I don't think this idea of investing with other people is relatively a new idea in real estate.
Mm,
In 2013, we had the Jobs Act, and so we had a bunch of new platforms come up like Fundrise and Yield Street and Realty Mogul, and there's hundreds of those platforms now.
mhm.
And usually to participate in the types of projects we're in, you have to be an unaccredited investor, $1
Yep.
million or more. And there are many syndications where you can accept unaccredited depending on how that's done, but those are legally not allowed to be marketed
Defined.
publicly. And if you look at the stats, before I got into this industry, one of the things I made sure to do was that I was in a growing industry.
Mhm.
And first off, the amount of funds and offerings that have been raising money in the private world has been growing exponentially since 2013, and over 96% of all funds are what are designated as a 506B exemption. So they allow unaccredited investors, but by law are not allowed to be publicly advertised. So if you
Mhm.
think about only 4% of all the opportunities that are available can only be marketed to multimillionaires, and that's a very small percentage. So I think many reasons why, but I think that's
That's a big
one
one.
major contributing factor.
Yeah, and it gets even worse. Most 506(b)s still don't allow unaccredited investors because there are more disclosures, more paperwork, more auditing. So most of the 506(b)s even out there have just opted to have accredited only, and it's just them and a couple of their rich buddies. They know they can go get $10 million by making a couple phone calls to their network, and they're not going to be pooling capital the same way that a syndication that does allow unaccredited investors who are going to write a 25 or $50,000 check, they just don't want that in there because each investor comes with its own relationship, its own set of headaches, and its own set of expenses as well. And so they choose to just accept very large checks from accredited only, even though it's a 506(b), because they know they don't need to advertise it. They've got the network. I call it the good old boys club. And so it's a very small percentage of funds that unaccredited investors can get into. But then we have this kind of blown up with crowd funds and other options and Regulation A funds. I'm seeing a proliferation of these when we're at institutional events marketing to retail investors because due to inflation, we have more accredited investors than ever because $1 million just isn't that much money anymore. And so I think some of the institutions are coming in with these Regulation A funds and saying, hey, there's a retail market out there because you had what 1% of investors back in the 80s when they did this were like accredited. And now it's like almost 20%. That's a huge 20x in the last, what has it been, like 35, 40 years? That's a big deal. And so they're gaining attention from funds and they have now being able to say, oh, there are more options out there. So, how did you find the things that you eventually ended up putting your mom in? And how did you evaluate those? And can you talk to the listener, one, how you found the specific ones that you're using? Can you recommend those? And are there any that you wouldn't recommend? If you can, I don't know if you want to name names or numbers, but
Yeah,
yeah,
I think that kind of detail is helpful when you're
yeah, go
listening.
go for it. I just got back from the Fact Right conference last month, and we were not supposed to be in the room when they were doing the due diligence reports. It was only for registered investment advisors. They kicked everybody else out because and I asked one of the advisors, like, "Why are they kicking us out? What's going on in here at the closed door?" And they're like, "They name and name." Oh boy. So for the advisors, that was very helpful to see where the strengths and weaknesses were of these different reports. And so I thought, can we do something maybe similar but respectfully in public?
Yeah, I'm happy to. So I think I'll start with my first kind of unofficial LP investment in 2018, which was I started giving out hard money loans. My friends and I, we knew a guy in our GoBundance mastermind group, and the three of us banded together and each pooled 50K for a total of 150K to give to this real estate flipper for them to buy properties, renovate them, and then flip. And so we would get something like a 10%, 12% return on those. And I think there is one asset class I would say I'm weary of, but I think the way I would look at it is I don't think any of the assets classes and operators I've invested in were necessarily poor. I think it's that my strategy has changed and
Yep.
I didn't realize how the investments would actually perform and
Okay.
contribute to my portfolio. So to dive into that, my first goal when I started, you have to like, let's go back. Let's picture all of a sudden my dad passes away and we're like grieving slash need to figure it out quickly. We're
Yep.
trying to help my mom move out of her home. We're trying to renovate things. There's a lot going on. And then I also have a full-time job and I also own some single family real estate in Atlanta. And when I started, the first goal was how do I not lose the money? Rule number one, don't lose money. And I focused on working with institutional operators. And I think that was one of the best decisions that I made. And I like to draw comparisons to venture capital because I think they're very different in
Yes.
the idea that when you're investing in early stage companies, you are focused on who has the greatest chance to become big. They have great
Mhm.
ideas. They're able to execute and show a little bit of traction. But in real estate, that is not the person that I wanna bet on at all. I wanna bet on the person who's been able to weather multiple downturns, that has had stuff hit the fan, and you can see how that they've handled it. And so, very much on the other side of the spectrum, I'm looking to back the old gray guy versus the
Yeah.
young startup kid.
Yeah.
And First thing I invested in was the Reliant Self Storage Fund, number 3 by Reliant Self Storage,
I
and
know that
then
one.
I invested with Grant Cardone. He was very big, very popular. He's someone who I followed for a long time and I respected, and he had a deal in a fund that purchased some properties in Miami, and I invested there. And so I also got to understand what kind of reporting was helpful and good, and I started to understand like, "Oh, I should start asking operators, like, what does their reporting look like?
Yes.
Because they're all different, and do they provide enough, and am I able to follow along?" And so my journey was doing that. I was trying to place 50 or 100K with a bunch of different operators in a bunch of different asset classes. And I think I did everything from self-storage to multifamily to retail to development to I did ATMs, and I've done multifamily, and I've done different credit and lending funds and
Mhm.
transactional funding. And so I now have had the gamut. And I think one of the biggest learnings I've had that's shaped my perspective is that when I started, I wasn't in my goal was don't lose money. Let's invest with big operators. But I learned this concept from Robert Helms and Russell Gray from the real estate radio guys,
Mm.
and they teach this concept called the money pie. And this really resonated with me where when you're investing, you can invest for one of three things. You can invest for cash flow, you can invest for equity growth, you can invest for reducing your taxable income or depreciation, or you can do a mixture of all three.
Yep.
But if you think of it like a pie chart, if you focus on one, like equity growth, that has the highest chance of maximizing what you're going to get at the end. If you're only focused on cash flow, you should be able to get higher returns by focusing on things that only provide you cash flow. But if you invest in something that kind of does all three, you basically get just a little bit of all three. And I think that's really shaped how I think about my portfolio now, where I have quite like over $1 million in different debt funds or credit funds that are designed to give me cash flow.
Mhm.
And then I have other investments primarily in equities like the stock market, where the purpose of those investments equity growth. And I've separated the two. And I think that's just as we're talking through it has been
Yeah.
one of my ways that my strategy has changed over time.
Okay. I have a similar kind of strategy change. I'm concerned about how it's affecting my diversification strategy, however, because at Rise Capital, our three tenets are one, higher returns, two, lower risk, and three, giving back to your community or basically living your passive income dream there. And for me, when I start focusing really hard on one thing, it lowers my diversification, which increases my risk, or at least my perceived risk. The things that cash flow tend to be much lower risk. So I feel like even though I'm shifting over that direction and putting a lot more money towards cash flow, because once you retire money, right? Equity growth becomes much less important. And so I found that when I first started, I was all about the equity growth. My husband had a good job. So I was just 100% of my time, real estate professional, focused on this. We got great tax benefits off of his W 2 because I was doing this full time. I never took a dime out of the business. I just kept reinvesting everything in high growth stuff and active stuff that I was managing because I needed a bigger pile of cash to then invest passively that would spin off enough cash flow. We just didn't have enough when we started. I was like, how can I go make the most amount of money in the least amount of time possible with the least amount of risk? I'm not gonna go do chasing crazy get rich quick stuff, right? But solid, stable stuff. And then when he was like, "We have enough equity now, I could quit my job." I'm like, "We ain't got any cash flow from all that equity, right?" None of that's realized. And so I started having to divest stuff and then put in stuff that cash flows, mostly credit, like private lending, all of that. And we had to pull some out and actually live on it. So that was killing our golden goose for the compounding. So we're trying to live on as little as we can to keep it compounding, getting out of the higher risk stuff of not so interested in growth, really focused on cash flow. And I feel like once we're living on, say, 5 to 10% of our portfolio cash flow, then I might shift back over to some of the high growth stuff, or at least add a little bit more of that back in. We don't need it for tax. We're both real estate professionals now. I have so much depreciation carried forward. Like I'd have to sell a lot of stuff to use up all that depreciation. And so we're just not doing equity right now. But I just wonder, am I less diversified now than I was before? Like in some ways, yeah. But I think the risk has gone down because the stuff I'm investing in is lower risk. I don't know. Speak to me
Well,
about those three things.
yeah, I think You harped on a kind of a point that has been more clear to me is that as you go through different stages,
Mhm.
you have different needs from
Yes.
your investments. When you're 21 years old, like cash flow, you don't even have money to invest for cash flow, right? Like everything
Exactly.
should be in high growth type things. And if you're super old, that flips and you're primarily only looking for cash flow. And I think depending on where you are in life, those needs come at different times.
Mhm.
For me, I'm 34 years old and I have taken I could take most of my money and put it in the stock market and go work at a venture capital firm again. I think I've had this 80-20 approach. I always invest 80% into things that cash flow
Mhm.
and then other 20% in high risk things. I'm willing to take more risk with that bucket because I have the stable cash flow.
Mhm.
The way I think about it is, once I get to 300K in cash flow a year,
Mhm.
then everything on top of that switches into the equity bucket.
Yes.
Everyone has their own kind of style or preference or based on if you have a W-2 or if you run your own business, but the way I thought about it was I can take the assets that I have them cash flow, and I believe that I can spend the rest of my time building a new business that will be valued much more than me working somewhere and just have my equity investments grow.
Yes. And I'm a lot older than you are, so I think that we've gotten to the point where we're running our business. It's more of a lifestyle business. We want to help 100 families reach financial freedom by offering them high return, low risk kind of stuff, right? But we really like the retired lifestyle. Like we're really enjoying slowing down. We do not want to scale to a big business. I shut my syndication or my multifamily business, really scaled back. We're not acquiring new stuff, at least not as managing partner. And I just really work in some like lame jobs, if that makes sense. It's like people are like, oh, you should be scaling this. You can make so much more in the business. I'm like, I'm sure I probably could. And my kids are older. And so they don't really need me as much anymore. So I really do have the time to do it. But I just am really enjoying this low key, low stress lifestyle. And I think that's kind of the whole point of what you're talking about because you're seeing it from your mom's perspective, much older, and your own perspective, and seeing how those goals of shift, not just in income, but also just how we want to spend our time doing what. So, what does that look like in your life versus, say, like your mom's life?
Yeah, I think the biggest thing money is basically a tool,
Mhm.
right? And what I like about investing for cash flow is that and particularly passive investing for cash flow is that it just gives me optionality.
Mhm.
For my mom's retired. Like, she just I'm tackling it all for her, and for
Yeah.
her, she's living out the rest of her retired life, and good for her, she's done so much for me, I manage all of this stuff for her, and for me, I'm very much still hungry in my career and what I wanna do, and so, for me, it's been like, you can take a summer off. I did take a summer off, and I went to Europe and traveled around the world, and eventually, I got bored, right?
Yep.
And I then figured out, what do I wanna spend the next 20, 30 years doing? And to me, it was like, I wanna get better at investing, I wanna surround myself with wealthier people, and I wanna be location independent, and this type of business helps me do that, and I get to give back and help people who were me several years ago. So,
Mhm.
I think the biggest piece is that no one is many people use these types of investments to go and retire, but even people like my brother is 55 years old, and he's now going through this transition in investing for cash flow, and we're talking a lot about where should he be investing, and it's not so much about retirement. I think nowadays people are more like they have optionality
Yes.
over their time.
Work.
And it's whether you want to do more of your hobbies or start another business or work at a charity or whatever it is, I think, or make a bet on yourself like I am. I think everyone has different reasons, but you can only do that when you have passive cash flow
Eh,
coming in.
It's you're talking about like the pie. You got the tax savings, the high returns, and the cash flow, and how much of that pie we want invested in each thing. But when you want to have that optionality, the tool is the same, cash flow, right? You have to that is like that top. Let's look at this like Maslow's hierarchy of needs, right? The base of that would be cash flow because you cannot quit. You cannot make a change. You can't follow your passion. You can't do any of that until your cash flow is taken care of. So let's go down that road a little bit. How much money does somebody need right now to be able to live a basic middle class lifestyle on their cash flow and not have any other job or any other thing. They're just, this is how much I need to put away to live a normal kind of a millionaire next door lifestyle. What are we
Yeah.
looking at?
Yeah, this is like one of the first questions people ask me when they come through my program. The simplest way to think about it is if you have $1 million, you can make 10% on that money, divvied out through monthly distributions.
Mhm.
So if you have $1 million, you can make 100 a year before pre-tax.
Okay.
So, probably like 60 or 70K after
Okay.
tax. And those are the basics, right?
Mhm.
You could stuff all $1 million in that. You could have 4 different funds that you have 250K in. There are some funds that'll produce 8 or 9%. And then there are some funds that maybe are a little bit riskier that have a different strategy that generate between 12 and 15%.
Mhm.
There are many different variables you can go through to try and figure out, okay, what is the average net number? But if you even go down to the 8% mark, there are so many funds that offer in that range. And yeah, I would say that as a benchmark.
Okay. Let's go up to tier 2. In my opinion, that's tax savings because just like we said, if you're living on an income fund and you're drawing money out of it, you're going to get taxed. And so what's your tax mitigation strategy so that you can make that $1 million or that 100K a year go a little farther, right? And get you closer to the actual number that you're drawing off. What do you look at for tax mitigation strategies? Because for me as a real estate professional, I'm paying the income or capital gains taxes if I do it right. Like I have tax relief in that. But for somebody who's still working, say a W 2, or both of them are working a W 2, should they be thinking about tax mitigation? Is it too soon? Because there's just really not that much they can do. Should they be putting their mind towards saving taxes later? What does that look like?
Oh man, okay. Love this topic. Hashtag not a financial
Yes,
advisor.
yes, yeah,
Anything I
disclaimer,
say is
disclaimer.
not on your
Well,
yeah.
I guess we
But
could put this in what kinds of funds and opportunities do you bring into your ecosystem for people who need to think about tax abatement?
yeah, I'll make it there are several things that I've learned here that I wish I knew when I started. So I think I'll maybe call out what I see as something I hear pretty often of there are ways that you can invest in real estate and get cash flow and have it be tax free. Basically, made money, like invested in some type of real estate, commercial real estate, maybe it's multifamily, maybe it's self storage, whatever, mobile home park, and they get cash flow and these assets, there was a ton of accelerated depreciation, and people have been able to live off of their income completely tax free. And whenever the deal exits, they would roll the equity or the whatever they made, the profits, into the next deal that also offered accelerated and bonus
Okay.
depreciation and so I'll just stop there and say it is possible.
Okay.
I will say that I think the dynamic and the economic environment is changing
Mm.
or has changed, right? Where interest rates have gone up significantly, prices have come down, property insurance and taxes, like everything's doubled or increased significantly. And bonus depreciation or accelerated depreciation is in its final years, and we're not sure if it's being
Please
brought
bring it
back
back.
yet.
Bring it back. With all this
So
inflation, he's got to bring it back.
we'll see. But I think the point is, I think if you're listening to a podcast like this, I don't want you to walk away thinking that the expectation is, oh, I should be able to make tax free income and it's going to be really easy to do. I think the environment is changing, and
Mhm.
there are some regulations and laws that play a big factor in this. That said, I think it depends on your goals, right? If you are a W 2 high income executive, you make a lot of money and you pay a lot of tax. There's one vehicle that I know, two vehicles that I know that you can use in order to offset the taxes that you pay as a W 2 executive. The first is you can invest in oil and gas. There are ways that oil and gas projects can be set up so that you are technically an active partner instead of an LP. And during the first year of an operation of an oil and gas investment, typically those investments happen at the end of the year so that You're active for less than 30 days, you get the tax break, and then you get switched over to being an LP. That type of thing exists and I think is the most common way.
Yes.
The second way is if you're going the more active route. So we're not talking about passive investing, but is this short term rental loophole where you can buy short term rentals and you can use the depreciation from your Airbnb type project and write it off against your active income, assuming that either you or your partner has real estate professional status, which comes with its own set of requirements and ramifications. So, those are two ways to think about that. I think the other way is okay, how do you make sure that the tax or the cash flow that you get from your investments is tax free? Then what we do is let's focus on assets that have a lot of where there is a building or something that depreciates. Any kind of building, whether you're investing in triple net leases, self storage, multifamily, office, all of these things have depreciation and will have a contribute to you not having to pay tax on the income that you receive.
Mhm.
There are unique asset classes that provide different benefits. So, for example, if you invested in a mobile home park, most of the infrastructure that is on the property of a mobile home park actually can be depreciated over 15 years, give or take 15 or 17 years. Whereas if you invest in single family or multifamily real estate, the buildings can depreciate over 30 years. And if you're investing in office space or basically anything that's not multifamily, you get actually taxed over 37 and a half years. So, depending on that's why I think when you're starting your journey, understanding the entire landscape of all of the different things that you could invest into and why you might choose them is so important
Mhm.
because if you are looking for the most depreciation, you might look at mobile home parks as an asset class, or at least that is a contributing factor you deciding which asset class you're going to invest in.
Yeah, but you still have to get a good deal in once you decide on the asset class, you still have to find a good deal in the asset class. And I think sometimes people they lose it. Oh, it's in an opportunity zone. I'm like, please, that's doing a bad deal just because it's in an opportunity zone is no excuse. You're not going to save as much on taxes. I see this a lot in the institutional funds. They're like 1031 exchange, DST, all that, and we'll pay you like 4 cents. Right. As like that return is not worth what you're saving on the taxes in a lot of cases. Your situation may be different. That's why it's really important to work with somebody who knows the space very well because I made some dumb tax decisions early on in my journey because I didn't know what I was doing.
Yeah, I think that's true for anything that you do, but
Yeah.
I've been trying to figure out how do I shorten my learning curve, and
Mhm.
it's always been by finding people who've done this that can tell me the nuances.
Yeah. A lot of nuances, especially I think taxes is a massive nuance. Lots of exceptions, lots of yeah, it's for me the easiest thing was just to be like when one part of the couple is working a W-2 and the other one is a real estate professional, to me that was like the king of all tax breaks because it's also I hate to say this kind of a lazy solution because it's the biggest lever that we have and I didn't have to learn how to pull all the micro levers because I just pulled that one big lever. But this isn't going to work out for a lot of couples. They might both have great high paying career jobs. I was a real estate photographer, so it made sense for me to basically come home and become a real estate professional. But for some couples, that's just not going to work. And again, like you said, it's going to be one of those things where you have to just look at your particular situation and work with somebody who knows what they're talking about. We talk about that a lot. Make sure your advisor matches what you're trying to do. If they're just only know about public markets, they're not going to be able to guide you through a lot of the stuff. If they're only dealing with a lot of real estate, they might not understand the plight of the double W-2 couple, but we're talking about leaving those W-2s and becoming job optional, retiring early, so to speak, or at least retiring to something else that they want to do to spend their time. So, what funds are you currently offering? What is in your stable in your ecosystem right now for things that are working for your clients to be able to retire early on stable, reliable income?
I each I can talk maybe about the funds I'm in that work
Yeah.
well, and then I can also talk about maybe what I help people with.
Yeah, because your
Slightly
goals are gonna be different than your investors' goals sometimes, and I think they'll ask me
Totally.
like, "Are you putting money into this?" And sometimes the answer is no, because your goals are not my goals. So I'm trying to find great opportunities for myself, but also for my fund, because not everybody in my fund is in my situation. So sometimes they're asking me for different things. So I think one of the very first newsletters I ever got from you a year or so ago, you went down and you just said, I'm in this, I'm in this and this. I'm not in these, but these are also things that you might want to look at. And I was like, okay, that's impressive that he actually just saying it right out there.
Yeah, I'm a huge fan of DLP Capital. I
Mm,
think they are the poster child for one of the best institutional firms that I compare every investment. They've audited financials. They've been around since 2006. They've never lost investor capital, never, at least in the funds I'm in, have never distributed less than double digits.
mhm,
They take a modest amount of leverage. There are a lot of things like that. So I'm in the DLP lending fund. I'm in the DLP preferred credit fund. I'm invested with a wholesaler that does transactional fundings. I get 10% from him. I'm in a cannabis debt fund called Polaris. I'm in an oil and gas investment, and those have been the big cash flow drivers
mm,
in my portfolio. When it comes to the offerings that I help people with, I think of it more like this. My focus is helping people through a mentorship program that we have called Cash Flow Academy get comfortable and understand the landscape and have someone handhold them through the process of learning who are all the players out there, what is my thesis, what are the 100 questions that I ask every operator to make sure I know, and then what I have is feeder funds that allow those investors to make their first or second investment into a large institutional player like DLP Capital with a $50,000 check instead of a $200,000 check. So
yes.
there are lots of different funds out there. And probably, like I mentioned in the beginning of the show, like one of the things I really think about is how do I invest with people with gray hair? And those are usually the large institutional funds. And so making it easier for people to access those types of opportunities.
Okay.
And
Yeah.
yeah,
That makes sense. One thing that I've been going down that institutional road, not us raising institutional capital, we're a retail fund, right? But finding fund of funds with institutional providers, right? So that we can same feeder funds, basically, like what you're talking about. But I was pretty shocked when I started going down that road. The institutions don't necessarily do a better job than the mom and pops, but they always come with higher expenses. And so I've had to comb those deals and those opportunities just as thoroughly as I was combing the mom and pop syndicators, because sometimes they're really good at what they do, but they just hardly pay anything because they have a lot of expenses or they're so reliable that you're going to take a lower return in exchange for that much safety. A lot of times they're just not good at what they do. It's been really interesting as we've been underwriting some opportunities. So I just want to point out to the listener, like institutional, we use that word a lot, but it doesn't necessarily mean throw money at any institutional fund, because
right.
obviously they'll do a good job. That's like saying throw money at any stock that's publicly traded because they've been through the regulatory process. That doesn't mean that you just can trust because they're
Yeah,
publicly traded that it's going to be a safe investment. So you still have to do a lot of due diligence either way.
100%. And there's drastic differences between institutional funds
Mm,
and returns. And there are institutional funds that go bankrupt. It's not like a catch all.
yeah.
Yeah.
But diversification, let's look at the S&P 500 like an index fund, right? And you can just say, "Oh, I'm just going to stick in this index fund and I'm going to set it and forget it, not pay attention to it." We don't have that much diversification in private markets. There's no 500 best private companies that you can just go set and forget in there. So what's a reasonable diversification play for somebody who might be used to this S&P index fund and they're looking to venture into private markets? It's a lot less diversification. It's like picking single stocks a lot of times. So how do you go about making sure that they have a wide access to a lot of diversified opportunities?
Yeah. And I think the way I think about this is inherently you can go on to platforms like Fundrise, Yield Street, Realty Mogul, and invest in smaller chunks. And if that's I if that's how you want to invest, I think different strokes for different folks. I think what's been fascinating about this process of needing to invest at least 50K checks at a time
Mhm.
is that it really forces you to do a rigorous amount of
Oh,
investment because it's a large chunk. And I've often had people tell me now that they end up doing more due diligence on these types of opportunities and understand them so much more just because of the nature of how that
yes.
plays out.
Yes. And I find a lot easier to do the due diligence than because when I was getting like public prospectus and trying to figure out how to trade in the stock market, I didn't know how to read any of that stuff. It was way above my head. I'm actually finding I'm understanding this a lot more over the last 10 years since we started getting into private markets. But there's a lot out there and it's a little bit more upfront management from the investor to pick someone, manage the portfolio. It's not going to be set it and forget it. Maybe technology will exist someday for that, but as of today, they have to be a little bit more involved in their own portfolio management, and I think it's important for them to understand going into that.
Which, yeah,
Yeah,
is important, and I think it is the new skill that you needed.
it's a very important skill, and it's I don't wanna say it's a job, but it's a little part-time side hustle to learn and about the stuff and be a portfolio manager.
I think let's be real, it is a new thing that's going to take up your time, and you call it a job, but I think there is no other choice. Like,
Yeah,
more money, more problems. It is just a reality that you need to manage money, and there's no way around it.
exactly. Pascal, how do people get a hold of you, and what type of person would you most like to talk to? The listeners out there and they're hearing this, like, who should reach out to you after the show?
Yep. So you can find me on LinkedIn, Pascal Wagner, Pascalwagner. If you type that in, you'll definitely find
Only
me.
one.
My ideal target avatar is W-2 executives that know they want to retire in the next 5 or 10 years, but don't really have a solid plan or a way to vet these types of investments and have done less than 5. That's my target and the people who I'm able to help the most. And if that's you and you found value out of this, I'm happy to help you if you think that would be helpful.
Yeah, perfect. I love that you're pairing it with education because there's some of that up front and then offering opportunities, like I said, in the same ecosystem to educate and have some things that they can start with and pick from. It's a unique model. And I think that you are crushing it and making some waves in the space. So I appreciate you spending the time with me today, Pascal, with our listener and just sharing your experiences and helping us figure out how we're going to go on our next passive income adventure.
Thanks for having me on the show, Emma.
Thanks so much. If you want to get a hold of me, investwithemma.com. Would love to talk to you about any of these things or connect you with any of the guests that we've had on the last 150 episodes of the show and help you get closer to your goals financially and give you the education that you need and hopefully passive so you have the time that you need so that you can plan your next adventure. Thanks so much. We'll see you next week.